Chapter. We're talking real money.
We live in a wonderful world for investors these days. It's a really great place to live if you're an investor, as long as you learn one simple trick, and that is kind of ignore the noise. There's a lot of advice and information out there that's silly, that just is sort of a waste of time. And one of the sources of data and information that we respect the most is Morningstar. Yet, hi, I'm Don McDonald, along with Tom Cock. This is the Talking Real Money, exciting, fun-filled, making more money make sense podcast that you tune to every doggone day and will for the rest of your natural life, because even if we're gone, we're going to have AI replace us.
Sooner rather than later, by the way. I'm hoping.
For Tom, it's like, wait, AI can give me more vacations? Yes, it can, Tom. AI can give you more vacations.
Perfect.
I just as an aside, before we get to the Morningstar story, I'm always off on tangents. This morning I was talking with ChatGPT, as I occasionally do, asking questions, wanting knowledge, learning new things, making sure that she sources everything. I know that's anthropomorphic. That's the way I work. I'm an anthropod. You know, that's the way it works.
You just wanted to say that 25-cent word. That's why.
So. No inflation. It's $1.25 now.
Oh, yeah. Okay. Pardon me.
Anyway, I asked, what new stuff is coming? And she goes, for you specifically, because like she knows me. She goes, we're working really hard on some new audio tools where AI will actually be able to not just transcript the audio, but actually hear the audio, hear mistakes, edit out the mistakes, clean it up, take out the ums and the ahs and the pops and the clicks, and do it independent of a human being. Goodbye, audio editors.
Here's my suggestion. I think beyond that, I think here's what we should do. All these 60-minute meetings that I'm part of, we pre-record it, have them fix it. It's actually a 30-second meeting then.
That's all the information that was worth.
That's all the information.
Exactly. Tom is living in meeting hell right now, apparently.
Meeting palooza, as I call it. So, good Lord.
Anyway, I'm so glad that I'm the creative. I am so glad I'm the creative side. Not management. I don't have a title. I don't have anything. I'm just like podcast guy. It's so wonderful.
Stop it.
I'm not Tom, but yet I don't get to take vacations like he does. Anyway.
You don't have to leave. You're in a vacation wonderland.
Yeah, I do. I do actually.
More people go to your neighborhood for vacation than anywhere else in the world, pretty much, right?
On Sunday, before it got really cold, I mean, there was frost on my car this morning. Frost!
Oh.
I didn't have to scrape it or anything. I don't go anywhere. Okay. But on Sunday, we were at a water park in 85-degree weather watching the football game. Depressing football.
Sorry about that.
Oh, at my
HOA
meeting, one of the recreation guy said, "Yeah, we have a big event coming up at the park. We're putting up a big screen, watching the Super Bowl." And after he finished, I said, "Nope. I'm the president of the board." I said, "No, cancel that Super Bowl party. There is no Super Bowl without the Broncos. I'm sorry."
Yeah, well,
bitter.
As they always like to say, and
yes, bitter.
They say with my team, there's always next year.
There's always another league.
Another decade.
Maybe we could go to the UFL.
Well, that's coming up fast,
and
too.
Win there. Yeah. Anyway, Tom's team's the Raiders, by the way, just to rub that in. Yeah. He's not a Seahawks fan. Yeah, Debbie was going during the Seahawks game, Tom's got to feel good about this. I said, no, he doesn't care.
Well, I do. You know, okay, but just to finish that thought, yes, I do, because I live in Seattle. Everybody's happy, and I get kind of on board with all that. Sure.
Okay.
Absolutely.
All right.
So I'll be rooting for them.
So you'll be rooting for them. I will be rooting for them. Dang Patriots.
Nobody outside of the greater Boston area roots for the New England Patriots, sorry to say, but that's just not happening. So that's going to be Seahawks by far in terms of support.
I guess we'll watch the game then. Anyway, Morningstar had an article recently that, of course, I had to read. I had to read it because the headline is "The Best Stock Funds for the Core of an Investment Portfolio in 2026."
Which would be different funds than 2025, apparently.
I guess. I don't know. Generally, you think they could write an article and just leave it alone. And I found something really interesting about the list. the number of actively managed funds that Morningstar thinks are worth buying have plunged to like unheard of levels.
Remembering that this list, this 10 years ago, probably would have been 2 index funds, and the rest, the other 19 or so, would be actively stock pickers, timers, managers that are really smart about the future. It would have been all of that, and instead it's completely the opposite. Now, what is it, 2 actively managed, and the rest are index funds.
Yeah, and I find that that's really, really interesting because it shows you just how much the world is changing. But even this article doesn't really help you out much because of what it's implying. That you need a fund or you need a number of funds. You need a core fund, and then you need to fill in around those funds. That you need to make it complicated. Yeah, go. Mm-hmm. Talk about that.
Well, they talk about the core portfolio, and here's their makeup. U.S. large blend, right? That's some growth stock, some value, I imagine. Probably mostly growth in today's world. Foreign large blend, right? These are international stocks that are, again, big. And maybe some mostly growth, a little bit of value, and then global large blend, which, again, I think what they're saying with global is a one stock sort of situation here, right? You own an index, you own the whole world. Here's my trouble with that as a starting place. First of all, core funds, isn't that something we used to talk about in like the 80s? You gotta have a core fund of this. And then because you're missing, frankly, if you use this advice, U.S. small stocks, really, U.S. small cap value stocks, international small stocks, international small cap value stocks, emerging markets value to get started. So the thing that I hate about this is, by their suggestion, you're going to have 5 or 6 additional funds to sort of build out a portfolio that's going to have all of the groups of stocks, we call them asset classes, in the portfolio. Why would you do that?
Yeah, and the other thing that I noticed when looking at this fund list really, really carefully is the fact that the vast majority of these funds are heavily weighted toward the S&P 500.
That's the point. And what's had the greatest run
the S&P 500.
10, 50. Right. So you're piling into the thing that's gone up the fastest. Wouldn't you rather be piling into the thing that hasn't? Well, no, okay, we got to correct that a little bit. International, developed, and international emerging stocks both made more than the S&P in 2025. Last year.
There is definitely a recent performance bias in Morningstar's list of best core stock funds.
Yeah, and we could go through. The Fidelity 500 Index Fund. Well, that's just the S&P 500, right? Mm-hmm. The Fidelity Total International Index Fund. Now, that's going to be, again, dominated by the S&P, but even outside of that...
No, that's international. I believe that's...
Yeah, but it's still going to have more S&P 500 stocks than any other asset class in the world. Guaranteed, because it's going to be 60% U.S. or 65% U.S.
Is it global?
And most of that's going to be in the S&P. Fidelity Total Market, all these iShares S&P 500. I don't understand why we need the Fidelity 500 Index and the iShares S&P 500 Index.
I don't understand why we need any index funds, any 500 index funds. I think
because those are just hold those same 500
Yeah,
stocks.
And by the way, I want to clarify, the FTIHX, the Fidelity Total International, that is ex-U.S.
Very good. Pardon me. Yes, you're right. Correct.
97%.
I was looking at the next one, global. The total market index
that
fund.
One.
FSKAX.
Yes, FSKAX.
That's what I was thinking.
That's the one.
Yeah, correct. That would be 65 or 70% U.S., again, mainly large. You just keep, but I don't know why we need all these, the Vanguard 500, the Schwab 500. You can just own one of those, folks. You don't need to own.
Oh, wait, I got to correct you on the FSKAX, too.
Please. Yeah.
I'm sorry.
Okay,
I hate to do this to you.
I'm rolling.
Because, it's all U.S.
I thought, total market. So I assume when I saw total market, that included total market.
No, so really to get the global market, you need FSKAX and
That's what I said. That's what I mentioned.
FTIHX. You need them
right.
together.
Okay, both of them.
But even then, your portfolio is heavy, large cap, hugely.
That's
heavy.
what I was getting to.
And
you're not getting much exposure,
and not value tilted like we'd like to see.
Yeah, you're not getting much exposure to small. You're not getting much exposure to value, and as I mentioned, in some cases, you're missing out basically entirely on things like international small cap value, emerging markets, small and small value. A lot of parts of the market that you want to own, and not just because they did really well last year.
But I got to tell you, their list, though, because
hard.
I think because of the fact that they call it the core of your portfolio, they intentionally they intentionally emit small cap and emerging. I think they're saying basically get this for your core and add on some other funds. And we're saying for a lot of people, that's just more work than you need to get involved in.
Well, but here's what they say. The mutual funds and ETFs in these categories provide a broad representation of the overall stock market, either the U.S. or globally. So again, you're representing the fact that you own everything. You don't own everything. You're missing things that are very important here. And so I think people would read this and think, oh, well, I'll just buy one of these and I'll have it all covered. You won't. You will not have it covered. Instead, again, and we've talked about this a lot, you have to make the decision if you want to just own an index fund that takes in basically larger, more growthy companies, or you want a factor-based portfolio. And by the way, Paul Merriman's going to speak to this at Retire Meet. Factors would include things like smaller companies, like value companies, like profitability, all the things we talk about. And now you can own them in one fund, right? I mean, AVGV, for example.
I looked at the best core stock ETF list that they have, and it's all Schwab, iShares, Vanguard, and State Street. They have totally ignored Dimensional and Avantis. And the other thing is they've ignored any small cap or any emerging.
Yeah, and my worry, by the way, when people do lists like this, here's what happens, because I talk to many of you. You look at the list and you say, oh, well, let's see what did the best over the last 1, 3, and 5 years.
And you're going to find that's the S&P 500 funds.
Exactly. And then you're like, I'll just pile into that. Well, two problems with that. Number one, you're chasing what's been great. Number two, you're really not diversifying then. You really want to be diversified into all these other asset classes. So, and frankly, in today's world, you don't need to have a core fund and all those other asset classes. That's what I was trying to get to. You could do it with one fund if you want to make it simple. And actually, you could do it with three if you want to do a little more work. But, why do you want to do that if you're going to do this on your own? Just buy the one fund, one global fund. And so it's just made easier by Dimensional, Avantis, and frankly now Vanguard, I think, is starting to build some of these same factor-based portfolios as well. So, yeah, I think this is a good start, I'd say, by the way, because, again, if you looked at this list 10 years ago, it was mainly actively managed funds, probably expensive. These are inexpensive. They're indexing, so we're trending the right direction, Don. The question is, do you and I have enough time to see them arrive at the right location before we are gone?
Well, it's still going to evolve after we're gone. But the fact is, I think
there's things are going to happen here after we're out of here.
Pretty darn sure. Given as much as has happened since we've been here, which
that's a good point.
Kind of, when you think about it, it's kind of amazing.
I try not to.
It's really pretty amazing when you think about when you were and I were kids. How did we communicate with someone outside of our home?
I had a tin can with a.
I did try that. It did not work.
Oh, okay.
It was totally ineffectual.
How else? I tried little rocks on her window. She never responded to that
either.
The
dialing thing?
That's right.
With the round knob with the holes. Yeah, right. We even had a party line once.
6971.
We lived somewhere where we had a party line. Where it's like if
I was always hoping for a party line, but I'm not that popular, so it didn't work out. So
you get on the phone and somebody else was already talking. It was like, oh, okay, I'll use the phone.
5 minutes.
You shared it with people in your neighborhood.
That's crazy to think about. Now you got it all right there in your pocket. So again,
a pocket. I answered my wife's call the other day from my wrist.
There you go. You're Dick Tracy all over again, speaking of aging yourself. So, again, there's nothing wrong with this. And you said it at the outset. We respect Morningstar greatly. I think
we do. I love their information. I use it all the time.
I just don't know if you're trying to make a simple portfolio, this is a place to start. Because this, to me, sounds like it's going to be more complex.
So if you had to choose,
if
you had to choose a core equity fund for a portfolio that would take into account all of these various things that you would like to see in a portfolio, Tom, this is such a setup. Which funds might you suggest?
This is baseball season. It hasn't even started yet. You already know the three.
No, we may have a new listener.
Okay, DFAW would be one. That's Dimensional's All World. AVGE, that would be Avantis' Global Equity Fund. Or, coming up fast, AVGV.
Which is their value-tilted, heavily value-tilted equity fund.
By the way, we're going to have a debate internally with our investment people about AVGE versus AVGV.
Oh, that'll be fun.
Yeah, I want to find out what they have to say. So,
going to be baseball bats hitting people left and right. You're wrong.
I can only hope. Well, it won't hit anybody here today because 4 people here, so you run around and hit the walls a lot.
Yeah,
I was
thinking about that general strike that was back a couple of weeks ago.
Yeah, apparently they got the wind of it, and they said, "Oh, then we're out of here."
Weeks ago, I even told Debbie, I said most offices won't even notice because nobody comes in on Friday anyway. They won't go. Oh, they must be on strike. No, it's Friday. They're never here.
Just to mention, today there are. Should I even say it? They'll probably get mad at me for this.
I don't care.
There's 1, 2.
Oh, how many people in the office?
Me plus 4, 5, 7 there plus 3 is 10. There's 10 people in a space that probably holds 40 to 45.
This is the world today, dude.
I know. There's just don't ever see anybody.
Nobody wants to go to the office anymore.
Nobody wants to see anybody anymore.
No, I don't want to. I mean, I can see you on my screen because you're in Bellevue and I'm in Florida, and that's as much as I need to see you.
I know. I got it. All right, let's get
wait. There are some advantages to this.
I didn't argue with you, did I?
Have you ever on a video conference or a video call had to worry about someone's breath or body odor?
Nope. And frankly, the other good news is you can shut down your camera
in a big meeting. You can turn your camera off and take a nap.
Click. Well, let's not go there because you're really going to expose my shortcomings.
Question time.
Yeah, she's written us before, Mount Airy. It's Angela. Thank you, Angela, for listening and keep writing. The question is, you were talking about AVGE and AVGV recently.
We just did.
And you suggested to a caller to change their IRA from AVGE to AVGV.
Yeah. V as
I'm thinking of doing that too. Is there any scenario where it would not be okay to switch in an IRA? Love the show. Thanks.
Yes, there would be a scenario in which it would not be wise to switch. That is if you have a lower risk quiz score. Your tolerance for risk is pretty low, middle into low. You don't want to. AVGV is by nature, by design, going to be more volatile. I mean, I can say that with a high degree of certainty. Mm-hmm. I'm not saying it's going to go up or down. I'm just saying it's going to go up and down a lot more than AVGE because it gets into riskier stocks. It's so simple.
Risky, not as risky as the Washington State Pension Plan, but risky nonetheless.
Yeah,
okay, moving on.
That's another podcast. That one's in the back catalog. You'll find it.
Gonna be fun. That's gonna be a fun.
That one was fun.
Has been fun. Was fun. Pardon me.
Jeez.
Somebody needs
I got to teach him about time delays. For some reason, he thinks when we're doing this right now that you're hearing it. You're not. You're hearing this 2 weeks after we do it.
All right, so I need to keep. Somebody needs to put that on a large panel.
We need to we need to actually have a calendar for you that shows the date it's going to be.
Okay, fair enough. Can you do that with the rest of my life too? So anyway,
I can't
bother.
help. I'm sorry.
Carl
you're a
writes
lost
Jefferson. Well, the days aren't that different, so it's pretty easy. Carl from Jefferson, Maryland writes, "Hi Don and Tom, longtime listener, love the show. Thank you for that. My youngest son is 32 and contributing 6% to a 401k at Vanguard.
Good.
Wonderful. Good. He's behind on saving for retirement. I will urge him to increase his contribution amount. You're a good dad. He has only access to Vanguard mutual funds, of which there are many to offer. He chose one of their recommended portfolio, which is based on a timeline to retirement. So he has a 42.1% in VT Sachs, which is
the total
U.S.
market.
Stocks. Yep. He has 19.5%, basically 20% in VTMGX, which is their international. He has 18% in VBTLX, which I think is the total bond.
Yes.
Pretty sure. And then he has 9% in VEMAX, which is emerging markets. And let's see, then 5.9% in VTABX, which for some reason I didn't look up.
I'll look it up.
And then he has another 5% in VGSLX. This is just a lot of work.
It's just a lot of work.
No, he's not doing the work, though. This is their they build this portfolio for him.
VTABX is the Vanguard Total International Bond.
So he has about 25% in bonds at 32. It seems like a high amount of bonds to me. Yeah. I don't love this, but I don't hate it. They're going to do the work. Mm-hmm. There's nothing wrong with it. I'd really like to see, especially at 32, a little more small, a little more value. But
although, hey, wait, he can't really do it given his choices. He doesn't have.
Well, not if he's going to use their portfolio, but if he went and bought it himself.
But maybe not in his 401 because they have a list of funds. I bet they don't let him pick everything. So let's assume that for a minute, that he can't pick everything. Here's one thing he could do. If he's already getting all of the match in the 401, and if he's still eligible for a Roth IRA, he can contribute to a Roth. Instead of upping his contribution to the 401, which basically is a deduction now, and if it's a regular one, not a Roth IRA is a nice adjunct to this, and that gives him the opportunity to go to Schwab or someone and get some of the Avantis or Dimensional funds to get that value small tilt in a better form.
Good advice. So build the Roth with the asset classes you do not have in this.
Yeah. And that's a way to keep the current portfolio he has in the 401k, the 75-25, and increase his equity exposure, which makes sense for his age.
Thank you, because that was one of my points.
Right. So don't change the exposure in the 401. Use the Roth IRA to increase the exposure to equities, and that gets you your value. You focus on value and small there. You use their value and their small tilt. You don't even use AVGE. If you're going to use an AVG, you use AVGV, or you just get small cap and value.
And what's the max is 7,000 in the Roth?
Yeah.
Okay, so you could do a pretty good job with piling into that. That's good. That's good. Okay, great. Don, you're very thoughtful today.
I'm trying
both
really
in your
hard.
whippings of me, which are regular and needed, and your responses to listeners.
You make
thank
it
you for
so
that,
easy.
for staying on top of things. I know, I'm trying. From Royal Oak, Michigan, Keith writes, now stay with me, this is kind of lengthy.
Okay, that's where the investment
Hi,
club
Don
group
and Tom.
is, the better investing or whatever. Royal Oak.
I had a eureka moment that I want to share on the podcast while driving down the first mile of paved road in America. We got paved roads here. Anyway, this is the first one. Okay, way back when. And he cited the road. It's Woodward Avenue connecting Detroit and Pontiac, Michigan.
Must have been paved because of
you
all the car
You got to look that up
companies.
while I'm doing this to make sure he's giving us straight facts here.
Okay, I will.
It's a 4-lane road on each side, 4 lanes each side.
Oh,
and there was
wait,
an
8-lane road?
I've never even heard of that. Well, Southern California maybe. He said there was a very aggressive car that was in a major hurry. They were swerving in and out of lanes, accelerating hard, braking hard, almost caused an accident or two. Everyone else on the road was minding their own business and driving with the flow of traffic. With all their best efforts to beat the flow of traffic, I saw the aggressive car stop at the same stoplight that I was approaching a few miles since they passed me. I wondered to myself, was it really worth it? Think of the danger they exposed themselves and others to. Think of the gas money they exerted by flooring it. Think of the wear they put on their brakes. Then it hit me. This is the exact difference between active and passive investing. Going with the flow of traffic, the same as investing in a globally diversified ETF portfolio that flows with the world's economy. Trying to beat the flow by making quick changes, following current trends, and exposing yourself to unnecessary risk is like our aggressive driver. It's dangerous, it's expensive, and just plain stupid. And you look like an idiot when it got you nowhere faster than everyone else. Thank you very much. Your philosophy around investing had a major impact on my life. And Tom's dad jokes are the highlight on my day. Don, don't fight it. Just accept it. The audience requests more jokes. All the best. All right. You were good until right at the end there, Keith.
Yeah, for me anyway. For Tom,
I use the same analogy
with the whole thing.
No, I use the same analogy of driving because, as many of you know, I come in quite early. I'm at my desk at 0500 hours because I don't like driving with other people. But oftentimes, it wouldn't surprise you, I drive about 65, okay? And not in a 30 mile an hour. This is on a freeway, all right? But there's people that pass me all the time going 80. And my little fragile ego goes, I should really go as fast as they can. And I start speeding. I'm like, no, if I stay at 65, it's going to get me from where I started to the end in the time which I've allotted.
With a greater chance of arriving there. Actually
That's
arriving.
As bad as my driving.
Yeah, exactly. And as bad as all their driving is.
Yeah.
Which you're very good at cussing out, by the way. You're just a
terrific.
pro.
So my daughter just still regales in the days of that. So I stick to the 65, and guess what? I get there in the appropriate amount of time. I think your portfolio should be managed the same way. You don't need to take risks. This is really spot on, Keith. This is very thoughtful.
In 1909,
and one day he can take your spot, I think, Don, because he's really doing his work.
In 1909, Ford Motor Company was building the first Model T plant in Highland Park, Michigan. Wayne County, the road engineers were excited about that, and they wanted a dustless surface on which these new vehicles and the other wagons and all could drive. So they did some studying, and they decided that concrete made sense, that they were going to create a test bed, a concrete road between 6 Mile Street and 7 Mile on Woodward Avenue. It's a busy route. Close. It was really close to the new Model T plant, so it was a really great test bed for this new way of paving roads. They built the first paved road out of concrete.
And, of course, nobody paves with concrete anymore because it's too expensive.
Oh, yeah, they do. I was just,
do they?
Oh, my gosh, yeah, I was just...
in this country? Surprised.
I was just up in...
Well, you haven't left this country,
in Asheville not long ago, and they're redoing 26... Interstate 26 between Spartanburg and Asheville up in the mountains. And the whole thing is paved with concrete, rebar and concrete.
That's cool. So thank you, Keith. Great historical fact. And here's the part that's amazing for me. That's the first paved road, right?
Mm-hmm. 1909.
Yeah. That's like 115 years ago.
Yeah.
The first one. Think of it today versus that's crazy.
Now, there were, let's be historically accurate. There were paved roads prior to that. They were paved with cobbles, with brick.
Good point.
Or with macadam. Macadam roads have been around for a very long time. They're just compressed gravel where they smash the kind of,
I like them covered with chocolate because there's nothing like macadam and chocolate. Yeah, they're really, really tasty. A little chewy, but delicious. So
that's good. He didn't even look at the word, and he got that it was macadamia. That's pretty good. You just add an IA on the end.
Trying to do better in 2026.
All right, are we done?
I think we're done. I think that's enough for them, for me, for everything.
Okay.
So I think
we're going to end it.
About it. Yeah.
About 50-50. This was about a 50-50 show. About 50% money talk, about 50% nonsense. So pretty good balance.
So, yeah, but I tell you one thing that you really, if you haven't signed up for retirement already, you really should.
It's basically all that.
I know.
They just get the virtual.
Bellevue is virtual is all you got left, but. It's fascinating to me because I had a call from a guy who's 34 yesterday, and he's coming. He goes, now I know retirement's still 25 years off. I go, yeah. But there's things in there that, like Paul will talk about portfolio design.
Right.
There's all kinds of stuff there that's usable.
They're going to help you get ready for it.
Yep.
Yeah.
Exactly. So you don't have to be 65 to attend. By the way, should you retire at 65? What's your take on that? Because that's
well,
the average
if
is
you
64.
are in a physically demanding job that you're
like
not that you
podcast.
Don't like. You don't enjoy
like
going
doing
to,
this podcast. Sorry.
What? You're short of breath from flapping your lips?
I have to stand up while I do this.
Oh, they made chairs. There's one in the office there. Go sit. Move your mic lower and sit your ass down.
There's about 30 that are open right now. If you must,
you could just wander aimlessly around the office because you're on
set up the microphone.
This is This is a portable mic and a computer. You could just I'm going to sit here for 5 minutes and here for
Nobody's
5 minutes.
Nobody's going to care. Who is that guy? They don't know. So anyway, so join us for Retire Meet. That's coming up March 7th.
This is
virtually nothing to attend. So there you go.
Well, no, there's money. You got to pay.
That's what I said, but virtually
it's
nothing.
A virtual thing. Okay,
yeah,
whatever.
It's pretty inexpensive. Paul Merriman, Christine Benz, Don McDonald, all the big stars you know from finance.
Jeez.
And other stuff will be there.
Okay.
No pressure.
Sounds like fun. Joe saw CI too.
Joe was the highest rated speaker last year. I have to admit it, so sorry it hurts, but that's the truth.
Just don't call him Joe Seal Saw High. He doesn't like that.
No.
Saul See High. Got it.
There you go.
All right.
Yeah.
Thanks for being there. Send your questions in at talkingrealmoney.com. We love getting your questions. You can type them or speak them. And if you want to actually speak with a fiduciary advisor who's not going to try and sell you anything, okay? Not. For a few minutes, you cannot hire them for free. That's really stupid financially. Oh, yeah, everybody gets free financial advice. You get free financial advice. You get free financial advice. No, we would go out of business.
She doesn't need it. She knows enough to do it on her own. So
well, she doesn't even need to know anything. She has so much of it, kind of like you. You could mess up and you'd be fine, Oprah.
Rolling in it every night before you go to sleep. That's right, man.
He has the little bill rolling room.
Exactly. I'll be out in a minute. I feel so much better.
All right, we got to go. Thanks for listening to, what's the name of the show again? Oh, yeah.
It's called
Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.